Gary Booysen from Rand Swiss standing by to bring us details around those market moves. Another day in the red, Gary, but not quite like we saw yesterday. Was a little less bad than what we saw today. Some of the big issues are the earnings that are being reported globally, some disappointing numbers coming through from some chip stocks, but also uncertainty around the conflict in the Middle East. What would you say were some of the other big drivers on the local bourse moves today?
So there really is a lot of news. We've got, as you said, the earnings season starting up, but we've also had a particularly heavy data week. So we had, obviously, the CPI numbers out locally, but yesterday we had very strong retail sales, which I think that negativity is still feeding into the market. And when I say strong retail sales and then say it's negative is, of course, we want to see the environment in the US starting to tighten. We've had a lot of interest rate increases, and we want to see US consumers slowing spending. We didn't see that in the US bank earnings that came out last Friday, and we saw consumers essentially drawing down on savings balances, and that theme really continued into the retail sales numbers yesterday. This morning we also had a GDP print out of China, so China growing at 4.9%. Most big international banks have forecast that China's growth would dip below that 5% level, so I don't think there was too much of a shock there. But even so, we saw resources heavily on the back foot. The resource index finishing just under 2% lower. And then, of course, we've got local results as well, so we've plenty to chew on today.
We do have plenty to chew on indeed. And before we get to those local company updates, I just want us to reflect a little bit on the price of Brent crude at just over $91 a barrel now. And then couple that with the rand that's trading at around 19 rand and 6 cents to the US dollar. Net importers like South Africa are not about to have a good time.
Yeah, so certainly I think this is not helping the CPI expectation going forward. And if you look at that number, remember that we've also had a much stronger dollar. So if you look at the US 10-year Treasury yield as well, we're sitting at 4.9%. So we've seen a big lift in that yield, and it just speaks to the whole idea around the risk-off environment that we're feeling at the moment. One, we've got the US that's too strong, but as you mentioned, the tensions are rising in the Middle East, and there's a real fear that this geopolitical conflict could widen. And if it doesn't remain between Israel and Hamas, and we see the likes of Iran being brought into the contract, we perceive disruptions to oil production, in the likes of the UAE or Saudi Arabia, this will have a significant impact on global markets. And with that, you've seen the Brent crude oil price, which was below $90 a barrel, lifting above 91 again. And this is in the context of a much stronger dollar as well. So obviously that higher yield just attracting investors to the stronger dollar. So all around not good news for South African consumers. And while we do expect around a 2 rand per litre cut in November, which might help ease things slightly, this can't be sustained if we have a weak currency and high oil prices.
No, absolutely. And it can't be at a worse time as we approach the festive season, Gary, but I suppose these are numbers we'll continue to watch. Those company updates that you alluded to a little bit earlier, let's start with Pick n Pay. Its first ever interim loss, about 13%. The company in general has not been doing too well. And obviously now with the leadership changes, it is hoped that some positivity will start to come through there. But what did you make of that financial statement, which I'm sure shareholders were not happy to see at all?
So definitely not happy to see. So as you say, the first interim loss, but that was headline earnings per share, essentially down 245%. The 13% figure was just the share price decline. So share price down just under 13% at the close, and that really a whole raft of problems for Pick n Pay. And it was interesting to see such an aggressive share price reaction, given the very, very detailed 26-week trading statement they released earlier in the month, highlighting things like load shedding, saying that if just around 400 billion in 400 million at least in load shedding and diesel costs had been removed, they would have obviously had a much better result. But that for me strikes me as strange, because a lot of these retailers are facing the same sort of pressures that Pick n Pay are facing, and you can't just pin it on load shedding. They've also mentioned obviously the idea that there's a switching at DC that had some retrenchments, which have also cost them. But really this isn't really where I think the meat of the argument should be made. if you look at their internal selling price inflation, I mean, that came in at 8.3%, while their like-for-like sales growth at a group level came in at 2.3%. So what that tells you as an analyst is that there was a massive volume decline at Pick n Pay. Where's that volume decline coming from? That's shoppers deciding to use other brands. And I think the competition that we're seeing specifically in the grocery space from the likes of ShopRite is just so stiff. And I don't think that Pick n Pay is standing up to it at the moment. And you can understand why Sean Summers has been brought back to almost steer the ship in the correct direction. So hopefully going forward we'll see better results from Pick n Pay, but today was an absolute shocker.
Yes, and thanks for that, Gary. It was indeed the share price that fell by about 13% on the back of that update from them. Thank you very much. And I will be speaking to Sean Summers within the hour, Gary. So maybe you want to tune into that and let's see what plans he has for Pick n Pay after this particular reporting. That is Gary Booysen from Ranswers joining us this evening to wrap up the markets day that was on at the JSE this afternoon.